When you look at the current business cycle, you have to take that into consideration. When we go to the business cycle, we are in a slowdown. We have recession-like situations in many parts of the world. China is in as deep a recession as in 2008 and 9. Europe is in recession, whether you don't take those numbers they publish for granted, all of them. The situation is miserable. It's really bad. The prosperity of the citizens is going down and not up. The cost of energy is much higher. The cost of life, of living, is much higher than it used to be. I just got an information for my real estate in Germany that the gas bill next year will be 50% higher, and that is natural gas, and that electricity will go up by 100%. So this is the situation we are in. I think this slowdown is not well understood because there are a few items that make it difficult to read, particularly the fiscal stimuli that some nations, particularly the US and the UK, gave to their citizens, created so much support for their economies. We do not know when that support finally breaks. We do not know, but when it does, then we will probably wake up in an unpleasant situation. And I think that could very well be the case in the first half of 23. Europe is in recession. Japan is not doing well. So Asia is really not doing well. The emerging economies are not doing well. They are struggling because of the strong dollar. They have to sell US dollars. There is reduce their reserves to finance their current account, their growing current account deficits. It's a messy situation. And the top dog in monetary policy is the US Fed. And the US Fed, Jay Powell would like to be Paul Walker, and he would like to make a statement. And so he runs a very tight policy, and he continues. And many thought we are close to a pivot because there are rumors that the next interest rate hike will be 50 basis points instead of 75. I think that's that's a misreading by the market. I think we are not there yet, and it will take longer. And more importantly than interest rates is the quantity of money. And when you look at the quantity of money that is withdrawn from the system, it is gigantic. M2 is down in nominal terms year over year, and in real terms, the slump in M2 is the worst since the depression of the 1930s. And people do not understand that. When I look at the world US dollar liquidity, it's down over 11% year over year. This is dramatic. It's the worst in many decades. So I think the quantity of money is shrinking, and this has an effect eventually on the economy, but first on the financial markets. And that's what we have gone through as a process. And the question is, when does it end, and when does the cycle turn? And quite openly, I do not know, but my guess is that I thought it at the beginning, a year ago, I thought it would be in late summer of this year. And then I realized it would take longer, and I put it off to late first quarter of 23. But now I have seen that the hedge fund consensus is for a low in Q1. So the market is never that accommodative that the consensus gets it right. So either it will be sooner or later, or it could be milder, or it could be deeper. And my hunch is that we could wake up during first quarter and realize that the economy all of a sudden is much weaker than we thought, and that the markets start another decline, go to new lows, and then the Fed and the FOMC gets cold feet. And with the weak economic numbers, with the markets down almost 30%, they begin to ease up on their tight policy. That's the working hypothesis I operate with at the present time. We see a few rays of sunshine. We have seen that the dollar is topping medium term, or has topped medium term. I don't think it is done completely, because usually in a weak economy, the dollar strengthens. And if the economy weakens more into the first half of next year, then we should have one more medium-term run-up in the US dollar, back to the highs or even slightly higher highs before it's done. Once that bull cycle in the dollar is over, I think then we are facing a multi-year decline that will be devastating for the US dollar, and also for most other fiat currencies. And I think the other side of the coin will be a multi-year bull cycle in gold. I have been neutral, hesitant, sometimes bearish on gold over the last 2 years, and it was a difficult time for our subscribers who like gold. And I got a lot of criticism, but gold is not the one-way street. It is the other side of the fiat currencies, but it goes in cycles. And I think the 8-year cycle peaked in 2020, and the theoretical low is due in 24. That doesn't mean that the price low must be in 24. It could be in early 23. And I think we are very close, or we are actually in a bottoming process in gold. We could deep down once again to around 1600 in the first few months of next year. But after that, I think we will see clear sailing and then go to new highs in the dollar, in gold, and down in the dollar. That's how I see it. In equities, I'm still expecting another down leg, medium-term down leg. I think we will zigzag around and go slightly higher into December, and not in a linear or straight way, but with big zigzags. And we could actually in the next week or 10 days or so, we could have a nice dip. But I think it's not over yet. We will go a little bit higher. Sentiment is coming back from deep pessimism to neutral, constructive, and will probably go to optimism. And once the investors are optimistic again, and the underlying fundamentals continue the way I see it, that means tight monetary framework, then I think we are due for another decline. My view a year ago was down about 30% for the major indices. We have been down 25% for the S&P. We have been down 35% for the Nasdaq 100. So we are not that far away from the low. And that's why I'm getting nervous, because I know it's the later stage of the down cycle. And it's now the fine-tuning over the next few months, how things will work out, and where I can position my subscribers long for a better market in 23. 23, I think we will have a nice and surprising decline in inflation rates. That is due to the weak economy, due to the correction in the commodity markets, and I think also due to some deflation coming out of China. So import prices will decline for 23, and that is probably an aberration in a new trend of rising import prices. That's a new secular trend due to deglobalization. So I think we could have a nice surprise in inflation on the downside next year. We will then also see, or I expect at least, 10-year treasuries to decline by up to 150 to 200 basis points. So a big run up in bond prices, decline in bond yields. And I think that should trigger a decent recovery in the stock market. The first up leg should be led by the growth segment, in line with the decline in bond yields. And I think the second up leg in that bull cycle into 24 will be led by the raw material related equities, from agricultural stuff to metals, to energy, to precious metals. The whole sector, that will be the most powerful sector for the second half of the next bull run. If I'm correct on that hypothesis, then I think inflation will rise again from late 23 onwards, and it will likely go higher, particularly if the Fed eases. If the Fed eases in 23, as I expect, then I think the liquidity created that becomes excess liquidity in the system flows into the assets that are scarce. And I think in the commodity sector, we have now weak demand, but we have relatively tight supply. And the tightness on the supply side is structural in nature due to underinvestment and due to the ongoing conflict between East and West. And therefore, I could easily see the oil price first going lower into, let's say, middle of next year, and then rising to $150, $200 in 24. And that should bring inflation back to, let's say, at least 10% or probably even a little bit above in the Eurozone and in the US. And you can imagine what that means for the bond yields. Bond yields will go up, and then we are in real trouble. And we know from the 1970s, which has some similarities, but which is also in many ways very different from the current situation. We know that the second run-up in inflation is the one that destroys the bond market. And so I'm very concerned what follows in the bond market in 24, from late 23 on 24, 25, 26, where a dramatic decline in bond prices could really trigger off dramatic changes in the world, because I would say by the middle of this decade, there will be no central bank with positive equity. And that's new. You know, they can operate with a negative equity, but the credibility of central banks will be gone. And that's new also. That's a new world. And I think the pension fund industry will have tremendous problems to pay their liabilities. And there could be a huge pension crisis throughout the Western world for state pensions as well as private pension funds. And state pensions, I forgot to mention, I expect several nations or governments to become bankrupt in this decade. So I think it will be a very dramatic decade that we are facing, with huge swings in the financial markets. And I think we are in the later stages of the first cyclical decline, in a big roller coaster that I see in the years to come. And I think that 23, from a low point, sometimes, let's say spring, into 24 will be a great bull run again. And many will think the good old times are back, but they won't. It is the last, it's the last few guys dancing before the music stops playing. And that's how I see it.